Okay, guys, we're going to go ahead and get started. We've got a full class today, obviously, with the midterm coming up next time. And we really need to go back through and really, I think, kind of start over on Chapter 4 because I think we kind of tried to rush it there towards the end. And I have a feeling that some of that probably didn't get a chance to sink in properly. So we're going to go ahead and go through the in-class Chapter 4 example that we went through last time, go through the slides in a proper manner for Chapter 4, go through the practice midterm for Chapter 4, and then get into the practice final exam, a midterm exam, excuse me, that I put up for chapters. And really that's focusing on chapters 1, 2, and 3. And then I really want to go through another set of practice questions with you towards the end of the discussion tonight to get us prepared for the exam. Okay. I'm noticing some faces of people that haven't been around. That's not how this class works, guys. And if you get me in a mode where I'm going to have to start taking attendance and that, I'm going to take your attendance and I'm going to start to drop people who make it a habit of not showing up. Okay, you need to be in this class to do well in it. So if you want to have a class where you can float in and out, I would suggest dropping this class and taking it with somebody else next time. But that's talking to some of the folks that just decided to float in here the class before the exam. Okay, that's not the way this class works. Okay, if you need to miss a class or something, that's one thing, but you just can't disappear and then show up the night before the exam. Okay, so let's go ahead and jump in and take a look. And I just want to start with this, which we had started last time. In fact, we went through last time, but I want to go back through it because I think it's going to bring out some of the key details of some of the things that we're going to need to know for our practice midterm for Chapter 4, or our quiz for Chapter 4, and then our when we go through the midterm, potential midterm questions. Okay, so let's just start with this company issuing this common stock, and it's probably best if you have your copy of this in front of you. That I think I gave it out last time, right? So try to get that in front of you. It's also up on Canvas. But we go ahead and we have this company that issues stock for $294,000. So if we've issued stock for $294,000, we obviously debit the cash, credit the common stock. Okay, and when we go from our journal entry to our general ledgers, we call that posting, right? And so we go ahead and we post to our cash $294,000. And remember, I wrote in common stock because I didn't put it originally on that example because it's the only entry that we made at common stock. But then I thought, well, might as well go ahead and have a complete thought. We debit the cash, we credit the common stock, right? Okay. Then we go ahead and we do this next transaction, and this company purchases inventory for $310,000, and the terms are 210 net 30. And remember, we said that that means that the company is offering a 2% discount if this inventory is paid for in 10 days. If not, the entire amount has to be due in 30 days. And I think I said, how come they don't call it 210 gross 30, since the gross amount is due in 30 days? But they pronounce that 210 net 30. And so we go ahead, and when we purchase that inventory, we debit inventory, we credit the accounts payable. You come over, and I just posted those, which was to debit inventory for $310,000, and then I come down and I credited the account payable for the $310,000, simply posting those journal entries, right? Okay. Then what? Then we come over and we say, okay, 10,000 of that sale is returned, or that inventory purchase is returned. I don't know. Maybe they gave us something that wasn't conforming to what we ordered or whatever. We discovered that. We send it back, right? Okay. And so when we do that, we go ahead and we debit the account payable for 10,000, credit the inventory. Obviously, we're not going to have to pay for something that we didn't keep, and so we go ahead and we credit the account payable. So now we only owe the guy net $300,000, $300,000, and we credit inventory to reflect that we don't have $310,000. We have what? $300,000 of inventory, right? Okay, good. So now we're all set, and we go ahead and we receive the bill for this, and we pay within the discount period. If it's 2, 10, net 30, that means what? 2% discount, right? So we go ahead and we take a 2% discount off of this 300,000. That means we're going to get a discount of what? $6,000. So what do? We are going to liquidate the entire payable for the entire 300,000 because what? We're going ahead and we're paying this thing off. The guy isn't going to expect any more money from us after we pay him, right? So we debit the account payable 300,000. That's zero, right? The guy doesn't want any more money from me. And then I go ahead and I do what? I'm going to only credit cash for $294,000, and I'm going to credit the inventory for $6,000 because I didn't pay $300,000 for it. I only paid what? $294,000. And so when you take a look at the inventory account up here, sure enough, the inventory is saying now it has a balance of $294,000. How much did we pay for it? $294,000. Don't you love accounting? Isn't it just beautiful? Everything always works out for you, right? Okay, good. So we have that inventory now. We've gone ahead and paid for it. And then we come down and we start to sell some of the inventory. And we sell it for $160,000. And we sell it for $160,000 when the cost was only $100,000. Why do we do that? Because we want to make money, don't we? Okay, so what do? We go ahead, we debit the accounts receivable, we credit sales. This is just like when we had revenue in the first in-class example that we had from Chapter 2 or whatever, but when we're selling merchandise, we call it what? We call it sales, but it's like our revenue, works the same exact way. And so what happens? We go ahead and we debit the accounts receivable for the $160,000, and we credit our sales. Did I tee up sales here? I think I did. Yeah. We credit sales for $160,000, don't we? Okay. Just posting those journal entries. Okay. Then what? Then we come over and we were given terms. We gave terms 210. Oh, sorry, I forgot. We got to debit our cost of goods sold for $100,000, right? Because that's what we paid for that. So we debit cost of goods sold for $100,000. Where'd my cost of goods sold go? There it is. We debit cost of goods sold for $100,000, and we credit our what? Inventory for the $100,000 that we just sold, right? Okay, so we debit cost of goods sold, we credit inventory. Okay, now you come over and you take a look, and we gave the terms 210 net 30, but before we get to that, now they return some goods on us that we sold. Okay, so when that happens, they return $30,000, and the inventory that they return, we sold it for $30,000, but it cost us $18,750. So when we have a sale return, we come over here and we debit sales returns. Okay, for our $30,000. Where's my sales returns? Well, that's the cost, but the 30 is the sales returns, which I'm just trying to find the account over here. Where's the sales returns? Oh, here it is. Thank you. Okay, thanks, guys. So we debit the sales return right there, right? Debit sales return for $30,000, and we do what? And we credit, now what did we credit? Come on, John. We credited the accounts receivable. Thank you for that, because we returned the account receivable, right? $30,000, right? Or the guy isn't going to pay us now, so we credit the account receivable for that. So now the balance is showing $130,000, and of course we had to do what? We had to put that stuff back in to inventory that got returned. So we go ahead and we debit the inventory for $18,750. That's for our cost, $18,750. We debit the inventory for that, and we do what? We credit the cost of goods sold for $18,050 because that stuff now was returned, wasn't it? Okay, so there's no cost on that now because we've had that item returned, and seem to be having trouble figuring out where I put everything today. Where'd my cost of goods sold go? There it is. And there's the credit to cost of goods sold, 18,750. So now our cost of goods sold has a balance of 81,250. Okay, now I think part of my problem is I've been trying to rush over here to the payment. When we finally go ahead and we receive the payment on this, the guy's going to do what? He's going to pay me, and he pays me within the discount period. Where's my payment now? So when he pays me, he's going to pay me within the discount period. Huh? Where is it? Up top here? Next to sales right here. There it is. So when he, thank you. So when he pays me what? He pays me within the discount period. So he gets a 2% discount. He owed me 130. 2% of that 130 is what? 2,600. So I'm going to debit my sales discounts taken. I'm going to debit the cash for the difference, and I credit the account receivable for the full 130,000 because I'm not expecting any more money from this guy, right? Once he pays me. So the accounts receivable gets credited 130. It's now 0. And I go ahead and I posted my sales discounts here for the 2,600, and I debited the cash now for the difference, the 127,400, which was the difference that he paid me off of that 130. Okay, so now I've gone through and I've looked at most of my transactions, but of course I remind you from chapters 2 and 3, whatever, that we have our rent expense and we also have our interest expense that we have to record as well. So we debit and credit those appropriate accounts, and I'm not going to post those. Okay, I think you remember how those get posted from our previous examples. Okay, so now we go ahead and we prepare our income statement first. We have sales of 160,000. We have the sales returns, remember, were 30,000. That was what they returned to us, the 30,000. And then what? Then we have that sales discount. So our gross sales minus our returns minus our discounts give us what? Give us this net sales of 127,400. Then what? Then we take off our cost of goods sold, which we're just pulling from our T account. The cost of goods sold, that was 100,000 minus the cost of the items that were turned back. That difference between our net sales and our cost of goods sold is what? Gross profit. We take that gross profit, and then we start subtracting our operating expenses. Operating expenses are day-to-day expenses, normal course of business. We cannot operate our business unless we have our what? Unless we pay the rent for our building, right? And so we go ahead and we subtract that off as an operating expense. So our gross profit minus our operating expenses give us operating income. And then we subtract off non-operating items. For example, if we are incurring interest expense, or if it was an interest revenue, we'd add it, but interest expense, interest revenue is considered non-operating unless we're a bank. If we're a bank, then incurring interest revenue, interest expense is part of our day-to-day operations, isn't it? But here, this is going to be non-operating. I'm assuming this company's a retail business, and we have our net income. Then we just pull our balance sheet accounts. We have what? We have our cash. We have our inventory. Gives us our total assets. We have our liability, our rent payable, which came from right there. I just stuck that in. We have our interest payable, which is right there, our liability. Our stockholders' equity is our common stock, which that didn't change from the beginning of the year. And then we have a retained earnings of 30,000, which equals our net income because I'm assuming this is the first year of operations. Okay, and they weren't paying any dividends here. And then I didn't show you the statement of stockholders' equity, but of course, we could do that right here. Why don't we just write that in? That's a good exercise. What's my statement of stockholders' equity going to look like? Statement of retained earnings, I guess is a better way to put it. Statement of retained earnings. What's the beginning balance? Beginning balance is 0. Then what do? Add my net income. Now I just showed net income. I don't repeat the income statement over here. That's what the income statement's for. So I just go ahead and I just show my net income. And then I go ahead and did I have any dividends? Okay, so dividends are going to be what? 0. And so the ending balance in retained earnings is what? 30,000? So if you had to think about the order for me to prepare these statements, what order would I prepare them? Which one do you think gets prepared first? Huh? Income statement, good, has to be prepared first, so I know what my net income is. Then I can go ahead and do what? Prepare my statement of retained earnings, because that's going to tell me what the ending balance is in my what? In my retained earnings, so that I can do my balance sheet, so that my balance sheet will balance, right? Okay. Okay, good. Any question on that? Okay. Okay, good. So I'm going to go ahead and close that out. That is sitting there on Canvas, and this whole discussion will be sitting there on Canvas. Okay? Well, good for you then. If you don't want to save the document, then I'm not going to save the document. I don't know why I didn't want to save it, but I'm not going to sweat it. Okay? All right. So with that as an understanding, let's just go ahead and go through the slides for Chapter 4, which we sort of started those last time, but I just felt towards the end we kind of crunched through that a little bit. And so let's just go ahead and look at these at a more reasonable pace here, which we have our merchandising companies, and you see that Walmart, for example, is probably one of the biggest. They have Walmart up here? Yeah. It's probably one of the biggest merchandises ever. Okay. I mean, the Romans probably would be impressed with Walmart, right? Okay. So you sit there and you have all of these different retail entities, which they do not manufacture their inventory. They buy the inventory already produced, and then they sell it to somebody else. That makes it a retail entity. It's different than a service entity, which is what we were studying in Chapter 2, right? In 101B, you will study how we would account for things if we were a manufacturer, okay? But we don't get into that in this class. We're dealing with retailers, okay? And so what happens with retailers, they're going to have their sales revenue. They will take off their cost of goods sold from that. Difference is what? Gross profit. They'll take off their operating expenses like rent, like the utilities, things they have to in costs they have to incur to operate day to day, and then they will have non-operating items. Even though they're not showing it on this slide, we saw it in our little example. For example, interest expense would be the classic example of a non-operating revenue if it was interest revenue, expense if it was interest expense, right? Okay, and we derive our net income. Now you come over and they just point out that the operating cycle for a retail entity is probably longer than the operating cycle for a service entity. What happens? Service entity, you provide the service, you've earned the revenue, right? If we're talking about a retail entity, we first have to acquire the merchandise that we can then turn around and sell. And so the operating cycle tends to be a little bit longer. Okay. What was that? A bomb or rats? I was in one of the trailers, the accounting lab trailer, and we heard rats scratching around in there. But I'm pretty sure they were rats. They sounded like rats. Okay, they were either rats or very small raccoons or something, but they sounded like rats to me. Anyway, okay, so that is going to be our operating cycle. Okay, now, what are the flow of costs? We have our beginning inventory that we have on hand at the beginning of the period. We purchase additional items to sell. That gives us what? Our goods that are available for sale. You subtract off your ending inventory. You have your items that you sell, and you're left with your ending inventory, right? Okay, so another way that you can calculate your cost of goods sold, then, if this is the case, is you have what? You have your beginning inventory plus your purchases for the period gives you your what? No, your goods available for sale, right? I started the year with 20 items in my inventory. I purchased 80 more. That means I should have 100 items available to sell, right? Okay. Then what? Then I go ahead and I subtract off my ending inventory. Those are the items that are still here, aren't they? And that should then generate what? My cost of goods sold, right? I had beginning inventory. I added items that I purchased for the period. That gave me goods available for sale. I subtract off what I still have left. That means the rest of it was either what? Sold or stole. Somehow it's not here anymore, right? Maybe my employees, took it from me when I wasn't looking or whatever. But what? It's still gone, isn't it? Okay, so that's really the way we think about the flow when we're trying to calculate the cost of goods sold. We would go ahead and have our beginning inventory plus our purchases. That gives us our goods available for sale minus our ending inventory equals our cost of goods sold. Now, what we were just looking at in that in-class example is what they call the perpetual inventory system, in which we will update our inventory after each purchase, and we will update our inventory after each sale. So at a press of a button, we really do know what our cost of goods sold is, and we know what our inventory balance is. There's something else called the periodic inventory system, way back in the day before computers got as sophisticated as they are, in which we wouldn't be able to keep track of our inventory every time we had a sale. And so what a company would do is every quarter, or maybe even at the end of the year, they'd go and physically count to see what was left in their inventory. And when they would count to see what was left, they'd say, okay, we know what we had last year at the end. Last year's ending inventory is today's beginning inventory, isn't it? Okay, the inventory 1231, the ending inventory 1231 is the beginning inventory January 1st, right? So we know that. We know what we purchased for the period because we had to pay for it, don't we? So we know what goods are available for sale. We count the inventory. This is what's left. Minus that must be the cost of what got, and again, sold or stole, but it's not here anymore, right? And that's how you calculate your inventory under the periodic method. In this class, we study perpetual method. We know what the balance is of our inventory and our cost of goods sold at a press of a button, don't we? So why am I bothering you with this stupid thing if it's not used anymore? If we're not going to use it in this class, it might be used, but if we're not going to be using the periodic method in this class, why am I bothering you with this stupid equation? Because you could have a question on your exam in which we'll say, here's the beginning inventory, here's what they purchased for the period, here's the ending inventory, what's the cost of goods sold, and you're going to use this little thing to help you to answer it, aren't you? Okay? And so what happens? You got to know this thing like a Catholic priest, don't you, to be able to answer questions? So what does the Catholic priest say? Beginning inventory plus purchases equals goods available for sale minus ending inventory equals cost of goods sold. You need to be able to rattle it off just like that, right? And if you can, then you're in pretty good shape to sit here and do what? Answer questions that are going to expect you to look at that, okay? Okay, good. So let's just go ahead, though, and we're going to study, for the most part, the perpetual system. And with the perpetual system, when we purchase inventory, what journal entry will we make for the purchase? We just saw it. Is inventory an asset? going to debit inventory when we purchase the inventory. What did we purchase? 300,000 in that little example, whatever, or 310, whatever it was. And we're going to do what? Credit my account payable, the 300,000. Okay. And then if I sell $100,000 worth of that for 160,000, what am I going to do? Debit the accounts receivable, 160,000. Right? Credit the sales, 160,000. But for this discussion, the more important part is, what do you want me to do with the inventory? I said it was a cost of 100,000, huh? Credit my inventory at its cost for 100,000. Good. And credit. Did I sell this stuff? Debit the cost of goods sold, right? So I don't have to sit there and use up that Catholic priest formula, do I? Okay, because I know what my cost of goods sold in my inventory is at any moment. What is the balance in my inventory account? What's the balance in the inventory account? I bought the inventory, so I would have debited it for how much? 300,000. Good. So that gave it a balance of 300,000. And then what? I just sold 100,000 of it. So this is a credit of 100,000. So what's the balance here? Good. Okay. Now, let's say I'm using a periodic system, and I don't know what the balance is in the inventory. Each time I purchase inventory rather than debit inventory, I'm going to go ahead and do what? I'm going to go ahead now. This is the periodic system. I'm going to debit purchases. How much did I purchase? 300,000. Credit the account payable. 300,000. Let me know if I'm keeping you guys awake. Okay, and then what? And hear all this. Oh! Okay. I'm going to debit purchases. I'm going to credit accounts payable. Then what? When I sell this stuff. When I sell this stuff, I'm going to go ahead and I don't update my inventory account because I have to count it, right? So when I sell the stuff, there's no entry. Well, I shouldn't say no entry. I still book the sale, don't I? But on the inventory, there's no entry. I'm going to debit the account receivable. How much I sell for? 160. And credit the sales. But there's no impact on the inventory account is why I wrote no entry there. I was just thinking inventory right now. Of course, I have to record the sale. But there's no entry on the inventory, right? Okay. Then what? Then at the end of the year, I'm going to count the inventory, and I'm going to see that how much is left? You can just peek right here. There should be 200,000 worth left, right? But I'd have to count it for that. And so if this was my first year of operations, my beginning inventory would have how much? 0, because I just started. What are my purchases? Purchase is 300. So what are my goods available for sale? Goods available for sale are 300. I count up my ending inventory, and how much is left? I'm going to run out of room here. My ending inventory is 200,000. How do I know that? Well, I'm peaking at perpetual, right? And so that means I'm going to write it over here. My cost of goods sold is what? Is 100,000. You're like, well, yeah, I know, John, because I just looked at the perpetual. And yeah, if you have a perpetual system, you wouldn't have to go through this calculation to figure out what the cost of goods sold is. But if you're on the exam and I ask you what's the cost of goods sold and I give you that set of information, you still should be able to sit there and back into your cost of goods sold, right? Right? Yeah.
So I see 100,000 and I see 160,000. So what? Yeah, I mean, so what is the actual sales? Is it 160,000?
The sales is 160,000. The cost of the items is 100,000 because this guy's got to buy a new Porsche. right? So he's going to sell it for more. Now you may be saying, well, why would somebody pay 160,000 for something that could get 100,000? That's the retail business, right? You walk in, and they at Nordstrom, they have a person playing the piano, and they spray the smell of good smells in the air, and you walk in there and you go, oh, I'm willing to pay 60,000 for stuff that only costs 100,000, right? Okay, but this is the nature of business, right? Okay. Okay. And it could be the brand. And look, maybe this stuff is made in a factory in Iowa. Who wants to go to Iowa, right? You get to have it in a nice store right here in California, right? Okay, so there's a lot of other factors that go into that. Okay. Question? Okay. So let's go ahead then. That's what we did in red up here, those perpetual. That's what we're going to do in this class. Okay, and there's the periodic system. And again, what do we have? Beginning inventory plus what? Purchases gives us goods available for sale minus our ending inventory gives us what? The cost of goods sold. Okay, and again, we don't make you worry about perpetual in here in your exams and stuff, but sometimes it's just good to have this little formula in your back pocket so that if you get asked a question where they're making you back into something, you can use this, right? Okay. Okay, good. Come over then, and let's take a look at the advantages of the perpetual system, and basically it provides a better control. Oh, by the way, sometimes students will sit there and say, so under perpetual system, then you don't ever have to count the inventory. Is that correct? No, it's a good internal control to count the inventory regardless to make sure that the physical count matches what the accounting records are saying, even in the perpetual system, because if you don't do that, guess what's going to happen? By the time you get around to counting it, you'll see people walking around their warehouse like this, and it's not because they're doing Michael Jackson tribute. They're kicking stuff off the back of the warehouse so that they can go and pick it up later on, right, and drive away with it if you're not watching it. So you get a better control with the perpetual system, but you should still periodically count the inventory. Okay? Okay, I'm not going to go through this example, guys, because we already gone through one. Okay, and the one that we had, so don't worry about this example. But I do want to sit here and make sure that you're aware of these terms called free onboard shipping point, free onboard destination. Free onboard shipping point, free onboard destination. Now I'm going to assume that if your thumbs are about to fly off, you're not sitting there looking for the slides for this class. This is not a texting seminar. This is a class where we're talking about accounting. Okay? And so what happens? We come over and we take a look at our freight costs, and we define the freight cost under two different scenarios: free onboard shipping point, free onboard destination. Free onboard shipping point means that title transfers to the purchaser at the time that this person here puts the item on the truck. So this person was probably hired. Let me circle that person. This person was probably hired by the purchaser. This person was hired by the purchaser to come and pick up those goods for us. They pick them up. Now, title transfers the minute our guy comes and picks up that inventory. We now have legal title to that inventory. So if the truck crashes, the driver jumps out unharmed. Okay, we don't want to kill the driver off. But the goods are destroyed. Who suffers the loss? The purchaser or the seller? Purchaser suffers the loss because we hired the guy to come and pick it up, didn't we? Okay, and so title transfers as soon as he picks that up. Now, where this gets interesting in later chapters, we're not going to deal with it as much in this chapter. Where this gets interesting in later chapters is if the goods are in transit. They pick them up on October 31st, and the goods are coming all the way from the East Coast somewhere. Well, that'd be an awful long trip. They pick them up December 1st. That'd even be a long trip. They pick them up July 20th. December 20th. And they're still not here at December 31st. What happens? the purchaser will still include that in their ending inventory even though they have not taken constructive receipt of that yet, right? Because title transferred, legal title transferred what? On in this little wandering example on December 20th, huh?
Once they sign the invoice, put it on the truck.
Once it gets put on the truck, it is our inventory. We have to include it in our inventory for the period, right? You're saying, but you didn't have that until December 31st. Didn't arrive until January of the next year. Better example. Didn't arrive till January of the next year. It doesn't matter. We still include that in whose ending inventory? The purchaser's ending inventory. The seller will debit cost of goods sold and credit inventory, and they can take the sale, can't they? Okay, so that's free onboard shipping point. We include those items in the buyer's ending inventory. We take it out of the seller's ending inventory. The seller can record a sale, can't they? And the buyer suffers the risk of loss. Okay, now free onboard destination. Now what happens? Well, now this guy who's delivering it is probably the person that the seller arranged to deliver that to us. So now title doesn't transfer until what? Until we receive the goods. Okay? So what happens? Now the seller arranged for that, and at the end of the year, what happens? 12/31, those goods don't arrive until January. The seller leaves those items in their inventory even though they don't have them on their premises anymore. By that time, at December 31st, I don't know, they're sitting in Fresno still. They haven't gotten to Fremont yet, right? Okay? And so December 31st, what happens? The seller keeps those items in their ending inventory. They don't take a sale. They don't take the cost of goods sold for that because what? We haven't taken receipt of those yet until that next year in January in this example. The buyer will what? Will not recognize the purchase of those items. So they don't include them in their inventory, right? And more importantly to them, they don't have to take the account payable for that, right? Because they have not taken receipt of those items yet. That's free on board destination. Okay? Now, important. Free onboard shipping point means who pays for the freight? Huh? The buyer pays shipping cost this guy's got to get paid, right? So the buyer pays the shipping cost, and that cost is included in inventory. If it's free on board, what? Shipping point. Who pays the freight? The purchaser, the buyer pays the freight, and what? Those costs are included as part of my inventory. Any cost that you have to get to an asset, so that you pay to get an asset to where you can use it, is inventory an asset? Can I sell the inventory in my store in Nordstrom if it's still in Iowa? Unless my store is in Iowa, but assuming I have a store in California, I can't sell it in my store in California until I get it here from Iowa, right? So any cost that you have to pay to get an asset to where you can use it in your business is part of the cost of that asset. So it's included in the inventory. So if the invoice price in the inventory is what? $3,000? And the problem tells us the shipping costs are, and guys, sorry for my glasses. My other glasses broke today, so I am now truly an accountant, right? Because I got tape sitting here on my glasses as they're falling off, okay? So what happens? I'm sitting here, and I paid $3,000 for the invoice in that inventory, and the problem tells me that shipping cost equals $100. What's the cost of that inventory to the buyer? Not a trick question. $3,100 is the cost of the inventory to that buyer, isn't it? That says $3,100 is the cost of that inventory to that buyer. Okay. Now, same fact pattern, but they tell us that now it is free on board destination. Now who pays the freight? The seller pays the freight, and if the seller pays the freight, that is going to be considered, now we can put seller pays, and that could be pay shipping. Let's make that specific. Seller pays shipping, and that cost equals a what? Selling expense. It's an operating expense. That's let me write that a little better here, I guess. Operating expense. Isn't that part of the cost of doing business? It's an operating expense.
But sometimes they pass it through. They'll pass it through to the customer. So what happens then? A lot of people,
If I write a check and I send it to I arrange for this guy to deliver the material and I sign a check for him, that's a selling expense. If you're telling me I pass it to the buyer, that means I just increased the sales price. So the correct way to report that would be to have a higher sales price minus your operating expense for what you paid to this guy. That's the way to classify it. Okay? But it is a selling expense because what? It's part of the cost of doing business. What happens? Let's say you're looking at this table. Did they finally fix this table? And you're saying, oh, I'm not going to touch it because it'll probably fall over if I do. But you're sitting there and you're looking at this table and you want to buy it, right? And you're thinking, I can't get this stupid thing in my truck. My brother's not going to let me borrow his truck. Forget it. I'm not going to buy it. And the guy's kind of watching and he sees you kind of walking away. He runs up and he says, oh, yeah, we're delivering this week. It's a special on delivery, right? And you say, okay, I'll take it, right? So what happens? That is a selling expense because it helps you move your merchandise, doesn't it? Okay, so that's part of the cost of doing business. It's going to be an operating expense. It's going to be a selling expense for that. Okay, so again, guys, look at me. Free on board shipping point. Who pays the freight? The buyer pays the freight. That is, cost is what? Part of the cost of the inventory, right? Okay, good. Free on board destination. Who pays the freight? Seller pays. It is an operating expense. A selling expense. More generally, an operating expense. More specifically, what? A selling expense. Okay?
so if you pay taxes, let's say you're free on board shipping, you pay taxes and have it shipped. Taxes just go towards taxes, right? They're not going to go towards
Taxes. Who pays the taxes? The buyer pays the taxes.
So let's say we bought something to resell later on. I guess it wouldn't matter because you would pay taxes because you're going to resell it. So
Buyer pays the taxes as part of the cost of the inventory.
so it is part of the cost of inventory.
Yeah, anything that you have to pay to get that asset to your place so that you tariffs, everything is part of the cost of the inventory. Anything you have to pay to get that inventory, that asset, whatever it is, to where you can use it. For example, you purchase computers. Now you're purchasing equipment to use in your business. You have to pay that stupid little disposal fee thing that you pay. That is part of the cost of the equipment. Anything that you have to pay to get that equipment to where you can use it, to where you can take it home, to where you can have it, not take it home, but take it to your business, that is part of the cost of that asset. Okay? Okay, good. So you come over. And let's look at this one. I said we're not going to look at the examples, but actually this is a pretty good one for what we just looked at. So just look at this and what happens. We paid $150 and what? The terms were free on board. Do they tell us here? Okay, well, they should have tested us a little bit better, but that's all right. What were the terms here? If the what? If the purchaser was paying and we included it as part of the inventory, what were the terms? FOB shipping point, right? FOB shipping point. SP is shipping point, right? Okay, good. Here we treated the delivery charges as a what? Oh, and I probably should have been more specific. We call that operating expense, we call it freight out. It's freight out because what? Because the freight is going out as we're selling it, right? Okay, but notice that is what? That is an expense. It's an operating expense, isn't it? When the seller pays. If the sellers pay, what were the terms? FOB destination. Good. Okay, good. What do you think this is called then when we pay the freight? When the buyer pays the freight. I'm saying we. When the buyer pays the freight, what do you think that could be called? That's called freight in, isn't it? Okay. Okay, good. So again, freight out paid by the what? Paid by the seller, operating expense. Freight in paid by the seller, part of the cost of the inventory, right? Freight out, freight in. Okay, good. Come over and let's take a look now. And we already understand purchase returns, okay? And notice that we go ahead and we set up our accounts payable, we set up our inventory, and if they gave us a discount of 210 net 30, that means we're going to get a 2% discount on that, right? Okay, and this is the way we articulate this in this class, 210 net 30. This is the most common. Don't worry about these other ones here. And then what? Then we go ahead and if we pay within the discount period, we got a 2% discount, just like we saw in our little in-class example. We go ahead and debit the payable gross, and we credit the cash minus the discount, and we take that discount off the cost of the inventory, right? Right? Okay. Okay, good. If we don't pay within the discount period, obviously we have to pay the guy the whole amount, right? Okay. Now, if you look at the cost of this inventory, notice, guys, and this is probably a pretty important slide, okay? Because notice what happens. And it was the same thing that we did with the inventory. Remember, we subtracted off in the little in-class example. We subtracted off the discount portion. We subtracted off the parts we returned, right? And so if you're trying to sit here and figure out, well, what's the cost of this inventory? It's the original invoice price plus the what? Plus the freight in minus the amounts that we returned minus the cash discount, right? Okay. Okay, good. And then they go ahead and they sell stuff. And they sell the stuff for more than they paid for it, right? Why do they do this? Because they want to buy a Porsche. They want to buy a vehicle, whatever, right? Whatever your favorite thing is, that's what they want to buy. Okay? And then what? Then we come over, and if we take the discount, if the person pays us within the discount period, we debit the cash for the amount of cash we got. We liquidate the receivable, and since it was a 2% discount, they debit this account called sales discounts, right? So let's just go ahead and where do I want to keep track of this? I'll just do it right here. So our sales were what? Originally. Huh? It was 3,800 or 3,500? Where are you getting 3,800 from? Oh, 3,800. It's right here. 3,800, right, is what we paid for it. Less, remember we returned 300? Or we got 300 returned to us? All right, let's just go back. So originally was what? 3,800. They put up the cost of goods sold. Then what? They didn't show the return, did they? Okay, well that would help. I wonder, maybe I hid that slide by accident. Okay, so what happens? We have 3,800 was the accounts receivable. Sales revenue was 3,800, right? And if they returned the stuff, we would do what? We would debit the sales returns. And I guess they must have returned 300. And we would credit what? No, we credit the inventory for 300 because that stuff's coming back, right? And I don't know what they paid for that stuff, but if they paid $200 for it, they're going to do what? They're going to debit inventory for $200 and credit what? Cost of goods sold for $200, right? That's for the return. Put the stuff back in inventory, reduce my cost of goods sold. Cost of goods sold. That says cost of goods sold. COGS is cost of goods sold. Now, so if we're keeping track of our sales now, we have our what? We're trying to calculate. We'll come over. Then we go ahead and we sell this, and we sell it within, we not sell it, but we get paid for it now, and we what? We get paid within the discount period. They take a 2% discount, don't they? So it's going to be what? The 3,800 minus the 300 that was returned. That's 3,500 times 2%. That's a 70% discount, right? I mean a $70 discount. Okay, and so what happens? We debit sales discounts now, and we go ahead, we debit the cash, and we credit the full receivable, which is now down to 3,500 because we had 300 returned. So if we were to figure out our net sales, we would do what? Sales were how much? Originally 38. Okay, less, and we had the returns, didn't we? Was what, 300? And then we had what? We had the discount of 70. So our net sales is how much? 3,430. Good. How much cash did I get? 3,430. Don't you love accounting? It always gets you there, doesn't it? Okay. So we have what? We have the sales of 3,800 less the returns less the discounts. Did I write the 70 and it disappeared on me? No. Less the discounts of 70 gives me the net sales, right? Huh? Now we love it. Always works. Assuming the teacher remembers to write everything in. Okay. Question? All right, good. Come over then. If you guys keep yawning, I'm not going to show you the test that we're going to take next time. So keep yawning. Okay. All right. So what happens? We sit here and we have our what? We have our sales revenue, and what do? We have debits to our sales return and our sales discounts, don't they? To give us our net sales. Now, sometimes students will say, well, look, if you credited sales 38, why didn't you just debit sales 300 when there is a return and debit the discount for the reduction in price, and you don't have to deal with these other two stupid accounts, sales discount and sales returns. The company we mentioned last time, the company wants to track this, don't they? If their stuff is getting returned all the time, there could be some operational problem. Maybe we have junky merchandise that looks good on TV, but when someone finally receives it, they don't like the thing, right? Or what? This table over here, right? This table looks like it was mistreated to me. Look at that. It must be the rats. Okay, so what happens? We sit here and we do what? We want to keep track of that. Maybe whoever our guy is that's delivering the stuff is, messing it up on the way over. And we say, what's going on? We start reaching out to our customers. How come? Well, it was damaged when it got here. Oh, really? Let's not use that guy, the delivery guy anymore, right? What happens? Sales discounts. If everyone takes our discount, they're falling over each other to take the discount, then what? Then maybe we're offering too nice of a discount. If nobody ever takes the discount, what? Maybe we want to offer a little better discount, right? Okay, so all of these things can be determined from an operational standpoint if you do the accounting on it. We've already seen the closing entries, guys. I'm not going to go through those again. You know that to close revenues, you debit those. To close the expenses, you credit those. Difference goes to the income summary, right? And then what? The amount that goes into the income summary. If it's a credited income summary, to close the income summary, we debit the income summary. We credit the retained earnings, right, for our net income. And then dividends are sort of like an expense, but we don't run them through the income summary, right, because they don't show up on the income statement. So we just simply debit the retained earnings for the amount of dividends and credit the dividend account to close it. All of these accounts that we close got to be zero at the end of the year except what? Except retained earnings, right? Everything in here gets closed out to retained earnings eventually, doesn't it? Okay. Okay, good. Okay, couple of different formats for the income statement. Single step income statement versus multiple step income statement. Let's look at the multiple step first. And it's very simple, guys. You already know this because I already showed it to you in the in-class example, which is what? Sales less what? Returns less discounts gives me what? Net sales. I take off my cost of goods sold from that. That gives me gross profit. I take off my operating expenses. That gives me my operating income. And then I start going down and I start bringing in non-operating items. Classic example, interest revenue, interest expense are non-operating, right? Right? Okay. The other thing that they're showing us here as non-operating is gain on disposal of a plant asset. Gain on disposal of a plant asset. What does that mean? Huh?
Sold some equipment.
I sold some equipment. Yes, I did. I had equipment that I bought for $5,000. So if I bought the equipment for $5,000, I debit the equipment. Let's make it $500. I debit the equipment. I credit cash, right? Okay, good. Now, what happens? Equipment has a salvage value of $20. So I'm going to take the cost of that equipment, 500 minus 20 equals what? 480, and that's what I'm going to depreciate. And I said this equipment is going to last how long?
4 years.
Going to last 4 years. So in this example, I'm going to take depreciation of $120 a year, right? Okay. So I go ahead and in year one, I debit the depreciation expense for 120. I credit the AD is accumulated depreciation, 120, right? Right? I go ahead and I prepare the balance sheet. How much am I showing in the equipment account? How much do I show in the equipment account? 500. Very good. She's like, uh-oh, here he comes. He's going to beat me up. How much do I show in the equipment account? See, if only I had known accounting when I was a kid, I could have bullied all the other kids in the neighborhood with accounting. How much is in the equipment account? You don't know? Okay. So the equipment has what? Has $500 sitting in it. Good. And then what? How much is in the accumulated depreciation account right now? 120. So the what? Carrying value, also called book value, carrying slash book value is how much? 380. Good. That's the carrying value of that, isn't it? That's year one. Now, if I tee up accumulated depreciation over here, so far I've got how much in there? 120. That's year one. What entry do I make in year two? Year two, I do the same exact journal entry, don't I? Because I'm going to do that every year for the next 4 years. Okay? And so what happens? I go ahead, I make that journal entry again. How much is in the accumulated depreciation now? 240. So for year two now, my balance sheet will still show equipment of how much is in the equipment account? 500. The accumulated depreciation now is going to show how much? 240. And so now this asset has a carrying amount of, this equipment has a carrying amount of what? 260. Okay. With me so far? Okay. And so then what happens? Then I go ahead and I sell the equipment for $860. Why would somebody pay $860 for that? I have no idea, right? Because they could have brought it brand new for what? 500, but humor me, for some reason, it's just the most cherry, piece of equipment ever.
You got a deal on it when you bought it.
Huh?
You
I'm a shrewd businessman. I mean, Trump's got nothing on me, right? Okay, so I'm going to sit here and I'm going to sell this equipment for 860 now. And so when I sell the equipment for 860, huh? Right, when I sell the equipment for 860, what am I going to debit? A debit, I sell, huh? Debit Porsche. I'm going to debit cash for 860. Okay, I'm going to go ahead and I'm going to credit what? How much is in the equipment account? Credit equipment for 500. I have to get rid of that accumulated depreciation account now. How much is in the accumulated depreciation? Huh? 240, right? Is in the accumulated depreciation. I credit the equipment for what? 500. Do I need a debit or a credit to make this journal entry balance? I need a credit of what? Let's see. I've got 740. I got what? 1,000. What is that? 1,100 versus, huh? 1,100, right? That's 1,100, right? Okay, I have 1,100 here versus 500 here. I have to credit something for 600, don't I? I credit gain for 600, which is sort of like I would do if I had a revenue. I would credit revenue, wouldn't I? But we don't call that revenue because selling equipment is not our normal course of business. That's something outside of the normal course of business, isn't it? I mean, if I'm a retailer here, I don't get into the business of selling computers, but in this, well, unless I was a computer retailer, but assuming I'm Nordstrom and I sold a cash register, okay, let's use that. I'm not in the business of selling cash registers, so what do? I show that as a what? Gain on the disposal plant asset down in the non-operating section, right? Okay, so again, multiple step income statement, sales minus what? Returns, discounts, minus my what? Minus my returns and discounts gives me what? Net sales minus cost of goods sold is gross profit. Gross profit minus my operating expenses is operating income, very descriptive. And then I get into my non-operating things like interest, revenue, interest expense, gains. Could be a loss on the sale of equipment. It's going to be non-operating, isn't it? And that gives me my net income. What's my net income here? 31,600. 31,600. If you're wondering, well, what's this casualty loss from vandalism? These are things that are unusual. If something's unusual and it doesn't happen that much, I treat it as a non-operating item. In fact, it's obviously non-operating. I'm not in the business of getting vandalized, or if I have a fire or something that destroys a warehouse, I'm not in that business. So that would be shown as a loss, right? Okay, good. But I get my net income. How much is my net income? 31,600. Good. Now, when you look at the single step, start at the net income. Net income is how much? 31,600. Same exact amount, isn't it? Same exact amount. So the net income doesn't change. What's changing is the presentation, isn't it? And if you look, what we do is we take all of the pluses and put them together. Then we take all of the minuses and put them together in one big pile to revenues, gains, etc., right? Minus expenses, losses gives me my net income, doesn't it? So notice on here, we are starting with net sales, so we're not going to report out the discounts. We're not going to report out the returns. And notice, we do not report what? Gross profit is not reported. GP is gross profit is not reported. Gross profit what? Not reported because there's nowhere to put it. We're taking all of the pluses, putting them together, and then doing what? Taking all the minuses and putting them together, aren't we? Okay. I look at this and I'm like, why do they call it the single step? Shouldn't they call it the two-step? Step one is revenues. Step two is the expenses. And then I heard that the country western people were going to sue them if they called it the two-step. No, I'm just kidding. Never mind. So they call it the single step. Never mind. Sorry. Okay. All right. Question? Okay. All right, good. Let's see. Let's take a look at a couple more things, and then we're going to take our break, and then we're going to get into the practice midterms. That's it. Okay? Okay, good. So let's take a 10-minute break, guys, because we still got a lot of material to cover, because I still want us to get into the Chapter 4 quiz, the practice midterm, and then I want to spend some time looking over another document with you that I think will be helpful for you for your test, okay? So we still got a full agenda, so let's just limit it to 10 minutes. I know it's not long because everything's far away from here, but whatever you have to do, do it quickly, okay? I haven't seen one. Oh, no, no, no. It's okay. It's okay. All of that is resume the recording here. And let's just take a look at this. And this is the Chapter 4 quiz now. Chapter 4 quiz. Okay. And so we have this Nick company. And they have the following information in their trial balance. Remember, all we do with the trial balance is after we've made all of our journal entries for the year, we just make sure our debits and credits balance, right? Okay. And so just taking a look, you can see that sales is a credit. All these expenses, including the sales returns, allowances, etc., are debits. And then the question sits here and asks us, what is the net sales? Okay. And so I just went ahead and did our little calculation of net sales like we've been seeing in some of the slides in the in-class example. Sales minus returns minus my what? Minus my allowances, sales return allowances of 15,000 minus my, looks like I didn't write in my discounts very well here, but discounts is right here, isn't it? It says discount, I guess, okay? Minus the discount gives me my net sales of what? 538,000 for this problem. Sales minus the returns minus the what? Discounts gives me my net sales, right? Okay. Okay, good. Then we say, based on the facts from question 1, what is the gross profit or margin? And so what do? Gross profit slash margin. Those are synonymous terms. I've seen it called gross profit. I've seen it called gross margin. Difference between my what? Between my cost of goods sold, which was given to me up there. There's my cost of goods sold, so I just had to pick that up. The difference between my what? My net sales of 538,000 and my cost of goods sold, that difference is gross profit, right? Or gross margin, synonymous terms. Okay. Then I say, based on the facts, which of those are going to be considered operating expenses? And you just go back up to the list, and I put an O next to all the ones that I consider operating expenses. For example, is freight out an operating expense? Yes, it is. How about advertising expense? Got to incur my advertising expense. How about interest? No, interest is non-operating unless I'm a bank, right? If I'm a bank, I'd consider it operating, but for a retail entity like this is, no, I'm not going to pick that up. How about my salaries? That's operating. How about my utilities? That's operating. How about my depreciation? That's operating. I have to have equipment to operate, don't I? Okay, so when I add all of those up, I come to $117,000. Is that the answer to that one? 117? Okay. Then I sit here and I say, well, what's the operating income? Well, the operating income is going to be, and I didn't start all over again, showing you everything that went into net sales. I simply took my net sales less what? Less my Cost of goods sold gave me my gross profit slash margin less my operating expenses is my operating income, right? Okay. Okay, good. Any question on those? So that was pretty much right off of those last couple slides we looked at, right? Okay, so now we come over and they want me to talk about this one now where I had switches that came in at an invoice price of $4,000. Terms were 210, net 30, and so they tell me that I bought this inventory. And at the end of this, they want to put what amount, if we pay this, what amount are we going to have to pay when we pay this thing off? Because we bought some inventory. Okay, so what are we going to have to pay it off? So we sit there, we debit inventory, and we credit accounts payable for how much? Well, for the 4,000. I got to make this journal entry balance when I buy the thing, right? With me so far? And then they tell me I immediately turn around and send half of that stuff back. So if I send half of it back, what do you want me to do here? When I send half of it back? I'm going to credit inventory good for 2,000 because the stuff's coming back, right? Anything else? Debit the AP because I don't have to pay for stuff that I sent back, right? If you buy a shirt and you order a white one and they send you a black one, do you send it back? Do you and you send it back? Do you still pay them? No, right? So you don't have to pay them for that. You get your money back anyway. Okay? So that's going to be a debit to accounts payable. Good. So then what happens? Let's just go ahead and let's tee up inventory. Let's tee up accounts payable. So I started with what? A debit for 4. And then I credit it for 2. So the balance in here must be how much now? Balance must be 2,000. Good. Okay. And then what? Accounts payable, I credited it for 4, and then I debited it for 2. So the balance is also 2,000 here. With me so far? Okay. Then they tell me that I paid within the discount period. So if I pay within the discount period, that means, what's the discount? 2% I must have paid within 10 days, and I didn't pay the full amount in 30, right? Because I took the discount. So if I take what? 2,000 is what I owe on this account payable, and I take a 2% discount on that. What's that? $400 or $40? 40 bucks? Okay. And so when I pay the guy, I'm going to only pay him how much cash? I'm going to pay him $19.60. I'm going to go ahead and debit the account payable for the full what? For the full 2,000 because I'm paying the guy off now, right? So if I debit my account payable for 2,000, this is 0 now, isn't it? Okay, now the balance is 0, so I paid that off. I have to what? I have to credit something for 40, don't I? Good. I'm going to credit the inventory for 40, and when I credit the inventory for 40, it comes down to 1960. How much did I pay for it? 1960. Don't you love accounting? Isn't it beautiful? Right? So it always works out, doesn't it? Okay. Okay, good. Question on that one? Yes, sir. I did not go over it fast. Would you like me to go over it again? Okay. So what happens? I sit here and I buy inventory for $4,000. I credit accounts payable for $4,000, right? Okay. Then what? Then I go ahead and I'm posting that. I'm debiting inventory. I'm crediting the account payable for $4,000. Just posting that journal entry. Okay. Then they tell me that I immediately returned half of those, so I immediately returned 2,000, right? So I debit the account payable for 2,000, and that brings the balance now down to 2,000, doesn't it? So accounts payable liability. If I want to decrease it, I debit it. That's what I did. And I go ahead and I credit the inventory for 2,000 because I'm sending that stuff back. So now the balance in inventory is what? $2,000. Now I got to pay the guy, and I pay the guy what? Within the discount period, 2% if I pay within 10 days. Otherwise, I have to pay the whole amount in 30 days. I must have paid him within 10 days, so I get a $40 discount on that. So that means that I'm going to be able to write off this whole $2,000 in the account payable. There's that debit. I just post it, and now it shows zero, and it should show zero because I don't owe the guy any more money. Right? But I'm only going to send him 1960 because that was the agreement. I could pay him 40 bucks left as I paid him within the discount period. So I credit the cash for the 1960. I have to credit something. I credit my inventory, which had a balance of 2,000, and I credited it there for 40. That brought it down to 1960. And my only point was that what I'm showing the amount of the inventory is exactly what I paid for it, right? Okay. Okay. Okay, good. All right, let's take a look at this one. Which of the following is shown on the multiple step but not the single step? And we just looked at that was what? Gross profit, right? You don't have anywhere to really show gross profit if you're taking everything and glomming your pluses together, your minuses together, right? Unlike the multiple step, which is much more eloquent. Okay. All right. How about income from operations? Okay, do we know how to calculate that? Revenue is how much? 60,000. My expenses are what? 12,000? Oops. I'm leaving something out. Revenue, what made me leave it out is that they called it revenue. They're going to show me cost of goods sold. They probably should have shown me what? Sales would have been a better thing to call it. Sales. I'll fix that. There we go. Maybe not. Okay. Ugh. Okay, so my sales is how much? 60,000, and then I have to show what? Cost of goods sold, and my cost of goods sold here is going to be this 30,000. Thank you. So what's my gross profit? Gross margin? 30,000. Good. And now I lost track of what they want. We want to do what? Our income from operations. So should we pick up this operating expense? How about this equipment? That's going to be a non-operating item, isn't it? Right? So I go ahead and I pick up my operating expenses of 12,000. So that gives me what? Operating income of 18,000. Right? Let me ask you this. What if they ask me for net income? What if they ask me for net income? What should I do? Now I'm going to take this what? It's not a gain, it's a loss on the sale of equipment. They had a loss on the sale of equipment, right? So then I take the loss, don't I? 2,000, And so my net income would be what, 16,000 here if they had asked me that, which they did not, right? Okay. So interest and gain and loss on equipment are not considered operating items. So if I ask you for operating income, you ignore those. If I ask you for net income, you throw them in, right? Okay, good. Come down. What is my net sales for the month? Well, I have sales of 10,800. What do you want me to take off here? Okay, I'm going to take the returns off. That's 400. Good. And the discounts. Good. That's what, 200? Anything else need to come off here? No. So what is it? 10,200 is my what? Net sales. Okay. All right. Good. Using the same facts, what's the gross profit slash margin? So I'm going to start with my net sales. I'll give you that hint of 10,200. What do you want me to take off of that? Good. I got to take off the cost of goods sold to get my net sales, don't I? Cost of goods sold is what? 5,000. So my gross profit slash margin equals 5,200. I'm starting to think this test is going to be too easy if it's going to be like this. This is like, I got to write the department and tell them that we're making this too easy. We're destroying America. Okay. Okay. Huh? Okay. Probably the test's going to be harder than this anyway, but we'll see. Same facts as question 8. What is the gross profit margin ratio? We talked about this last time. Okay. So, did we? Okay, well, we'll talk about it now then. Okay, so gross profit margin ratio is defined as my gross profit slash margin divided by net sales. Good. Okay. You might want to make a flashcard. All these ratio ones, guys, I would highly recommend you make a flashcard out of the ratio just because, nobody wakes up in the morning going, today seems like a good day for gross profit calculation, right? I mean, it's just not something that's bouncing around in your head. So I recommend you go ahead and you flashcard that, okay? So what is my gross profit here? What's my gross profit here? Yeah, I can see. I see. You've calculated already. But what's the gross profit? I said. The gross profit is what? 5,200. Okay, good. And what's my net sales? 10,200. And that gives me this what? Close to 51%. Somebody said. Okay, close enough. 51%. Right? Okay. Again, one of these things that you just got to make a flashcard out of, guys. I don't know what else to tell you. I mean, that's just the way we calculate it. Okay. Sales revenue less cost of goods sold is what? Gross profit. I don't think you'll forget that one. Okay. Okay, good. Let's take a look at this one. And Glenn purchased merchandise inventory with a invoice price of $7,000 and credit terms were 210 net 30 and we pay within the discount period. What's the journal entry when I first purchased that stuff? Debit inventory 7,000. Credit accounts payable how much? 7,000. Good. Okay. Then I pay the guy within the discount period, right? So if I take the discount on that, 7,000 times 0.02 is going to be what? 140. Okay, so what's going to happen? I'm going to go ahead and I'm going to debit the account payable for the full 7,000. I'm going to credit what? Yes, I will credit cash, but before I credit cash, I'm going to credit inventory for 140, right? And I'm going to sit there and I'm going to credit my cash for the difference, which is this 6860, the answer to this question, right? Is how much I have to pay for this. Okay. Now, if I'm sitting here and I'm keeping track of my inventory account, I would have just debited it for what? 7,000 when I first got it. And then I just did what? That's 7,000. And I just did what? Credited it for 140. So the net amount that's sitting in the inventory now is 6860. Look it. Have you ever seen such a beautiful mechanism in your life is what we're doing here. Look at this. Shows up for exactly what I paid for it, doesn't it? Okay. Can anyone think of a faster way to answer this question? Why can't I just take 7,000 and if they got a discount of what? 2%, that means net of the discount is 0.98, isn't it? If you take 7,000 times 0.98, do you still get 6860? Right? Save you a little time on your exam. You got 40 questions, right? If you can look for a little time saver here and there, why not? Okay. Okay, good. Let's take a look at this one. So, we received goods for 20,000 and the terms were 210 net 30. So what should we do when we receive those goods? For 20,000. Journal entry. Debit inventory for 20,000 and credit accounts payable for 20, right? Okay. And let's just tee up accounts payable. Let's tee up inventory, I should say. Let's tee them both up. Why pick on one or the other, right? Okay. So that's what, 20,000? And we've got balances of 20,000 sitting here, right? Okay, good. Now what happens? Now they return what? 400? So if they return 400, what are they going to do? They're going to debit the accounts payable for 4 and credit the inventory, aren't they? For 4? Okay. So let's go ahead and do that. And now the balance, it was what, 20,000. Now we're down to what, 19,600 or something stupid like that? Okay, and we got to debit the account payable, 19,600. Good. Okay, so now we're going to sit here and we're going to pay the, we've got what? Freight charges, and we paid the freight charges, aren't we? The person that received it. So we're going to do what? We're going to debit inventory for how much? For how much did they pay? 100. And credit cash, right? To pay that inventory. So when we debit that, what's that now up to? 19,700. Right? Okay. Now what happens? We go ahead and we pay within the discount period, don't we? And right now they're telling us that we owe what? 19,600? Is that how much we owe right now? 19,600. 19,600, and we're going to get how much of a discount? 2%. So we take 19,600 times 2%. What's that come out to? 392. Okay, so we're going to get a discount of 392, aren't we? So what are we going to do? We're going to go ahead and we're going to debit the account payable for the full 19,600 because we're paying that. We're going to credit our cash for how much? The number you just told me is what? Well, 392, but I got to pay him net of that. I got to pay him 19,600 minus the discount of 392 that you just told me, right? So how much is that? 19,308 is the the credit to cash. 19,308, and I have to credit something. What am I going to credit? I'm going to credit inventory for the 392 because I didn't pay him the full 19,600. I only paid him 392, right? And when I go ahead and I now credit the inventory, where'd my inventory account go? Down here. And I credit it for 392, does the balance here come down to 19,308? Huh? Well, that shouldn't work back like that. Huh? No, that's part of the cost of the inventory.
So the cash amount is correct.
20,000 was what I paid for the inventory, plus what? The 100 freight that I put into the inventory equals 20,100 minus what? Minus the 400. Did I send 400 back? Minus the 400 I sent back is 19,700 minus 392 is 19,308. Calculators, please. Yeah,
Oh, it's 208. There you go.
19,208, 392. 19,600 minus 392 equals 19,208. Thank you. 19,208, and so 19,208 is what I had to pay this guy, and the discount, now I don't trust anything you guys say, 19,600 times what? Times a .02 discount is 392, and so 19,600, right, minus 392 is what? 19,208, so my journal entry balances, right? Right? Okay, thank you. So it should have been 19,208. And you say, well, John, how come the amount you paid doesn't match exactly what you paid for the inventory? That's because I did what? I paid an extra $100, didn't I, for that inventory because I had to pay the freight? And I didn't set up a payable for that. I did what? I credited the cash here, didn't I? I debited the inventory, I credited the cash. Right? Okay. Question? Sir. I did. Yeah, I did. There's the freight right there, the $100. So the difference between what I paid, which is not what the question asked, they wanted the inventory, and what I paid in the account payable and what I put in the inventory was the amount of freight, right? Right? Okay. If you're not understanding, I don't see any reason to quietly sit there and suffer unless you just want to go home and stare at this problem and not understand it. Is there a question on it?
Actually, can I just record the free as freight instead of put it into the inventory?
Because the rules are that any cost that you incur to bring that asset to where you can use it are part of the cost of the inventory. Okay? So let me do it again this question now that we have correct numbers for it. So I bought the inventory originally for how much? 20,000. So I debited the inventory for $20,000. I credited the accounts payable for $20,000. I tee up the inventory, 20,000. That gives me a balance of how much? 20,000. I tee up the account payable for 20,000. That gives me a balance of how much? 20,000. Okay. Then what? Then I go ahead and I do what? The mysteriously collapsing table, right? Then I go ahead and I do what? I return, you want to return the 400? Okay, so I go ahead and I return 400. When I return 400, this comes to 19,600. The account payable comes to what? 19,600. Okay, good. Then what happens? Then I go ahead and I pay the freight on that, right? And the freight, the rule is, goes into the inventory account. So I go ahead and I debit inventory for 100. I credit cash for 100 because them's the rules. You ask me why? 7 people decided that. They called it the Financial Accounting Standards Board. I don't know what else to tell you. Okay? And so what happens? They're the ones that are ruining our lives. So we go ahead and we debit the inventory. It's now $19,700. It's in the inventory account, right? Okay? Now, I go ahead and I pay the man, and when I pay him, what's 19,600 times 0.98? Because I'm getting tired of this 2% and then subtracting the 2%. 19,000 what? 208? Right? 19,208? So I got to pay the guy, so what do? I debit the account payable for the full what? For the full 19,600. I credit the cash for what? 19,208. And I have a difference here of what? 392. So I go ahead and I'm going to credit inventory for 392 because I didn't pay 19,600 for it. I only paid what? 19,208. So when I credit the inventory for 392, the balance comes down to what? 19,308, right? Can you think of a faster way to answer this question? If I'm looking at this question, I'm thinking, okay, 20,000. How much got returned? 400 gives me what? $19,600. And I took a 2% discount, so I paid 0.98 of that. That gives me what? 19,208. And then I know that I have to add back the inventory for $19,308. Just took me 30 seconds to answer that question. Right? Okay? Yes, sir.
On the test, are we going to have points taken off if we show?
No. You'll have points taken off if the Scantron key says that the answer is B and you mark C. That you get points deducted for. No. Are you crazy? Are you kidding? What? No. 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 Just because you asked in context of also asking, can you have notes? As an auditor, that starts to mean to me, look, guys, there's no notes in the class, period, in any of the Accounting 101, Business 101A classes. So I'm not going to start giving you guys notes. You're already taking your test a week later than everybody else. So I'm already taking heat for that. So I'm milking you along. I'm not going to sit here now and start handing out notes to you. Okay?
No, I don't know.
Yeah, no. Okay? All right, so let's go ahead and let's take a look at this next question. Okay? And the journal entry to record a credit sale is what? Debit to accounts receivable and credit to our sales revenue. We've known that for some time now, haven't we? Okay. Okay, good. Ray Company purchase of equipment on credit from Tyree Corporation on August 3rd for $7,000. Terms are 210 net 30. On August 10th, Ray makes the appropriate payment to Tyree. And so what are we going to do? And we've been practicing with this. I mean, this question's easier than that last one. You simply debit the account payable gross. You credit the cash less the discount, don't you? And the discount amount goes into reduces my inventory account, right? Okay. Okay, good. On November 2nd, 2012, Kasdan Company has cash sales of $4,500 for merchandise having a cost of $2,700. The entry to record the day's cash sale, and since it's a cash sale, I'm going to do what? I'm going to debit my cash for how much? 4,500. Credit what? No. Why would I credit? No. I see why you're wanting to credit accounts receivable. This is not the collection. This is a cash sale, right? You're correct. We would have credited account receivable if we had first set it up as a receivable, but it's a cash sale. So we debit cash, we credit the sales, okay? Then what? Then we have to recognize the cost of goods sold, don't we? So we debit cost of goods sold for $2,700, and we credit what? Credit inventory for $2,700, right? Okay. Okay, good. That's it? Okay. So that's chapter 4. Now we're going to go and look at this comprehensive midterm that's going to take us through essentially chapter 2 and 3. Okay, and then we're going to look at another document that I think is going to be helpful for you. Okay, so let's just go ahead and we can close this. Uh-huh.
So the bulk of the midterm is going to be in chapters 2, 3, and 4, or should we kind of like know like the terms for like chapter 1?
You should know the terms for chapter 1, but I'm not going to sit here and go through them. If you want to, kind of refresh with those, my best advice would be to look at the chapter 1 quiz and the lecture of that. Okay. Starting with the quiz whenever we went through the quiz. You don't have to watch the whole lecture, but I'd look at the quiz part of it and the quiz itself. Okay. Let me see. I guess I gotta find that file. Yeah, this is the practice midterm. I put it on Canvas under the heading practice midterm. Oh, you were helping me find it? Yeah, okay. Yeah. And I have no idea what this garbage is now. Why is this? What is this? This looks like a malfunction where I come from. No, remove the files. I don't want them. Oh, I see. It was just still showing or something. Okay, there it goes. Okay, let me get this right sized here. There we go. Okay. No answers. That's not what I want. I want it with the solution. 1 second, guys. I had it all open, but Word had to crash on me. So maybe it's this one. There's this one and there's this one. I'm thinking this one's got the answers. There we go. Okay, this is the one I want. Okay, this is the one you have. Okay. All right, so let's go ahead and let's take a look. And this one is asking me what? What's in my retained earnings? Right? Okay. So what should I do? I'm going to go ahead and I'm going to analyze my retained earnings. And so I'm going to start out with the beginning balance. How much is in the beginning balance? Good. 297,000. And then I had what? Thank you. Revenues of 185,000, and then I had expenses that I'm going to take off of what? 103,700. That gives me net income of 18,000, 82,000. Okay, so I'm going to add my net income, right? Okay, good. Then what? Do I have any subtracts? I'm going to subtract my dividend. Did they tell me the dividend here? 18,000 is the dividend. I subtract the $18,000 dividend. That gives me an ending balance in retained earnings. Is it this 360, 300? Okay, good. That's easy enough. Right? Okay. Okay, good. Let's go ahead and let's take a look at this one, number 2. And I hate this question. I wish I wouldn't have put it here. This is a dumb question. But anyway, let's just look at it. Because the way they're doing their closing entries here, okay, they're telling us that we had revenue of how much? 75,000. So they're going to debit revenue for 75,000. They're going to credit income summary. That says income summary for 75,000. With me so far? That closes the revenue, doesn't it? And then they decide to close the expenses separately. So to close my expenses, I have to credit them, don't they? Don't I? So I credit the expenses for 62,000, and I'm going to debit income summary for what? For 62,000. And then they tell me that they had these dividends, cash dividends. So when they gave the dividend out, they debited dividend for how much? 8,000. And they credited cash for 8,000, right? With me so far? Okay. And then they had to close the dividend account at the end of the year, don't they? Dividend is like an expense, but it's not part of the income summary. So we debit retained earnings for 8,000 and we credit the dividend, right? We don't run dividend through the income statement. It shows up on the statement of retained earnings like we were just working with. Okay? So now you take a look at these choices. Do we debit income summary for 13,000 and credit retained earnings for 13,000? Now I look at that and I'm thinking, well, only if the difference between 75,000 and oh no. Yeah, only if the difference between 75,000 and 62,000 is 13,000, is it? So what the heck are they doing here? Debit income summary for 13,000 and credit retained earnings for 13,000. Why not? Maybe this is why I hate this question. Debit income summary for 13,000. Credit retained earnings for 13,000. 75,000. I don't see why you wouldn't do that. I don't see what's wrong with A. I don't see what's wrong with B, huh?
Which one of the following entries could not?
Oh, thank you. That's the joke about the I'm afraid not, right? Okay, you got to recognize your nots. Okay, good. So that's why it's always good to read all the choices, right? Because you could read A, and if you missed that not, you'd miss that question, right? Okay, so not. This could be, couldn't it? This could potentially be a closing entry, so that one's not the right answer. Debit income summary 25,000. Credit revenue. Now, what do? We debit revenue and credit the income summary for the closing entry, right? Thank you. So that one is not a closing entry. Debit revenue, credit income summary, yes, we did that. Debit income summary, credit expenses, we did that. Debit retained earnings and credit dividends, we did that, right? So the key word here was what? Not. Okay. Not. Okay. All right. How about this one? After the closing entries, what will be the balance in the retained earnings account? Well, if the beginning balance is what? 130,000. I have net income of 42. What do you want me to do with the net income? Going to add the net income for 42,000, and then they pay dividends. What do you want me to do with the dividends? Subtract the dividends for 12,000. Gives me what? This 160,500 is the ending balance. Okay. Okay, good. The retained earnings account has a credit balance of 37,000 before closing entries are made. Total revenues for the period are 55,200. Total expenses are 39,800. The dividends are 9,000. What is the closing entry for the? And they're just limiting this to the expense accounts. You do what? You debit income summary. You credit the expense accounts to close them, right? Okay, number 5. Company paid $35,000 in dividends. The entry needed to close the dividend account. Again, when we pay the dividend, we do what? No, we debit the dividend, or maybe you can say credit retained earnings. We debit the dividend, what? 35,000 and credit cash, for 35,000, right? And then we want to close that dividend account, don't we? So we debit retained earnings, 35,000, and we credit what? Credit the dividend account to close it, right? Okay. Okay, good. We have these ledger accounts, and this one, there's definitely something wrong with this question, okay? And I noticed this yesterday, that this question is screwed up. Sometimes the test bank makes a mistake on it, okay? And so in the process of closing the income summary account, what will be posted to retain earnings when we close the income summary account, okay? So if we're closing the income summary account, we're going to do what? What are we going to do with our revenues? Good, you debit revenues to close that. That's 29,000. You're going to credit your rent expense to close that. That's what? 3,600? Right? Salaries expense is how much? 7,200. Thank you. Insurance expense 920. Thank you. How about my insurance expense? Oh, I got it. 920. How about depreciation expense? Got to close that. Depreciation expense, got to close that for what, 900? 500? Anything else that needs to be closed here into income summary? Anything else that needs to be closed in income summary? We got our revenue. We got these expenses. Anything else that needs to be closed in the income summary? Dividends need to be closed to retain earnings, but we don't close them through our income summary. We close them straight to what? To retain earnings, don't we? So it's not going to go through income summary. So what do I need, a debit or a credit here to make this journal entry balance? Huh? I need a credit of what? 16,780? 16,780 is the credit I need? Do I have a verification on that? My Wolverines? Have the Wolverines verified that? I'm thinking he's looking for the entries, but now the way his thumb is moving, it looks like he's checking the score of the debate or something. The Wolverines were calculating that? Is that correct? Okay, so that's a credit to what? To my income summary? I have no idea why the test bank thought that D was the right answer. It is not. What the test bank did was they closed accumulated depreciation. You don't close accumulated depreciation. It rolls forward period after period, doesn't it? There is no closing of retained earnings. The only way of accumulated depreciation, the only way the answer becomes 18,280 is if we also did a debit to retain earnings, which we would not. Or just debit to retain earnings? Yeah, which we would not. We don't, not retain earnings. Accumulated depreciation. We don't touch accumulated depreciation, right? So there's no way that that's the right answer. They made a mistake there.
So what happens if we come across this on the test? How are we going to know?
Is this a challenge of some sort that we're dealing with here, or what do you say?
Everyone's like, hey, we thought it was this, and I mean, are we going to review the test? Probably not, right?
Is there something that I've done that I'm unaware of, that I've acted like I'm going to sit up here and screw you on a question?
It wasn't you who did this. You caught it. We're just saying what happens if they didn't do it right on the test.
Well, that will be your job then to go through every single one of those questions and see if we'll go through the test. I'm not going to sit here and let you be screwed by a wrong question. Come on, guys. Okay? All right. So, temporary accounts. Okay? Temporary accounts are my income statement accounts. I don't think we said that before. Temporary accounts are what? Income statement accounts plus what? Income statement accounts are assets. Income statement accounts are assets. The income statement has revenues and expenses on it. The balance sheet has assets, liabilities, and stockholders' equity, right? Income statement accounts are not assets. They are revenues and expenses in the derivation of our net income, right? Right? Okay. But temporary accounts are those that go back to zero at the end of the accounting period, and the accounts that go back to zero at the end of the accounting period are what? Are our income statement accounts and our dividend account, right? Okay, so those are considered temporary. I guess income summary also goes back to zero as well, doesn't it? We put that back to zero. So any account that goes back to zero at the end of the year is going to be our is going to be our temporary accounts. An income summary is not an income statement account. We sort of hold it. It's a holding place, isn't it? As we're making our closing entries. Okay, but it'll go back to zero. So any accounts that go back to zero, we call them temporary. Any accounts that carry the balance forward from period to period is called a permanent account. Okay, now these are our what? These are our balance sheet accounts, aren't they? Accumulated depreciation, that's why it would not have been part of those closing entries. It carries forward from period to period, doesn't it? Right? Hello? Okay, guys, so we're done, right? We're done? Huh? Okay. So are these balance sheet accounts what? Are they permanent accounts because what? The balance carries forward from period to period, doesn't it? Okay. My cash, whatever's in my wallet when I go to sleep at night, the next morning it's in there, isn't it? So that makes it a permanent account. Okay. Any accounts that go back to zero and prepaid rent is an asset, isn't it? It's a balance sheet account, so it's not considered temporary. Okay. Depreciation expense is not a temporary account. It's not a permanent account. It is a temporary account. It's an expense. It goes back to zero, right? Okay. Okay, good. Come over. Let's take a look at this one. And which are our current... Yes, sir. Yeah. Permanent accounts are balance sheet accounts. Any balance sheet account is a permanent account. Okay. The accounts that go back to zero. I started out saying income statement accounts, but I realized that's a little too generic. Any accounts that go back to zero at the end of the year are considered temporary. Why are they saying they're temporary? Because they go back to zero. So whatever balances are in them are only good for that year, right? And then they go back to zero. The permanent accounts, they keep carrying forward their balance year to year, right? Okay. Okay, good. Let's go ahead and let's take a look at this one. And we say use the information in this adjusted trial balance to calculate current assets. Current assets are those that we're going to pretty much use up in a year or so, right? So how about cash? Cash is a current asset. Okay, and look at the cash in your wallet. I promise you it won't be there in a year. Now, you may replace it with other cash that you earn, but not that same cash, right? Okay, so we typically expect that a company is going to use up the cash in its balance in its account. And if it said no, we're reserving that cash for 5 years to pay for some equipment, then that cash should be considered non-current. But generally, cash is considered what? Current. Okay. Accounts receivable, we're probably going to collect on those in 30 days, aren't we? So we go ahead and we add that one in. How about prepaid insurance? We add that one in. We're probably going to use up that insurance in a year or so, aren't we? Even though it may be a 2-year insurance policy, we don't sit there and hassle ourselves over 1 year versus 2 years. Usually prepaid insurance is going to be gone pretty quickly, right? Okay. How about equipment? Equipment is not a current asset. You're not going to use up equipment in a year. So equipment is not a current asset. It's equipment. How about the accumulated depreciation with the equipment? No, not current. How about land? We'll never use up land, right? Okay, so do we have our current assets here? Okay. There they go. Equipment is not a current asset. You're not going to use it up in a year. Okay, office supplies probably would be current, right? You don't buy 3 years worth of office supplies, right? I mean, you're usually going to last, maybe a quarter or so with those. Okay, good. How about now the current ratio? This one's asking me for the current ratio. Current ratio is what? Current assets, yes, divided by what? Current liabilities, right? Okay, and so you go ahead and we just need to pick up the current assets that we just saw were how much? 45,600, and now we got to divide that by the current liabilities. So we got to go back through this stupid list and see which ones are current liabilities. How about accounts payable? Yeah, we're going to pay those off probably in about 30 days. Good. So I'll go ahead and add them up here. 17,000 for that. How about interest payable? It depends, but in this scenario, I guess we better go ahead and include it since they were kind of putting it there next to the account payable. The interest isn't due, it's a balloon payment that's not going to come due for 5 years or something, then it wouldn't be interest. So they could have been a little more specific there, but okay, they want to call it interest payable. Okay, we'll pick that up. How about the unearned revenue? Unearned revenue is typically going to be earned out in a year, so we're going to pick that up. How about long-term notes payable? Long term means it's not current, right? How about common stock and retained earnings aren't even liabilities, right? Okay, so we add all that up. What do we get here? Huh? 24,400, you say? Okay, good. So we take that 45,600, we divide it by 24,400. Do we get something in the ballpark of this? What do we get? Of this 1.87? Right? Okay. Okay, good. Come over. And there you can see the calculation right there. A company made no adjusting entry for accrued unpaid employee wages of 28,000 on December 31st. So what happens? The employees worked, say, 3 days. We'll make it 4 days at $7,000 a day, right, for the first 4 days of the month. Thursday was December 31st, and we don't pay them until Friday. So we have to accrue the wages for those 4 days, don't we? Right? So we go ahead. What did I say? December 31st was Friday? December 31st was Thursday. January 1st was Friday, right? So we have to accrue the wages for those 4 days, don't we? Monday, Tuesday, Wednesday, Thursday. And so if it's 4 days, and I said the employees make how much per day? 7,000 per day. Okay, that's 28,000, isn't it? So at 12/31, I should have done what? I should have debited salary expense for 28,000 and credited what? Salaries good. Salaries payable for the 28,000 for those 4 days because, hey, they worked 4 more days in December, didn't they? And only 1 day in January? Okay? And so what happens? If I had no revenues, let's say I had no revenues, my revenues were 0, and if I didn't take any expenses, my expenses were 0, my net income would be how much? The easiest question I'm going to ask you all night would be 0, right? Okay, but what happens? If I do this correctly, which I need to do, I would have had revenues of 0 still, but now my expenses would have been what? Would have been 28,000, right? So I would have showed instead of net income, I would have showed a net loss here of negative 28,000. So is it true that if I don't do this, I overstate my net income by 28,000? Right? If I make that mistake, huh? Somebody say their loss? Oh, yeah, well, I understated my net loss, however you want to say that, in this particular example, but I don't know what just happened, but my net loss is 28,000, right? Okay. Unearned revenues are generally a what? Liability. Prepaid expenses are generally what? An asset. A company's formal promise to pay is called a what? Note payable. Hey, I just thought of a pretty good joke. Donald Trump forgot to pay his taxes. Okay. All right, come over and let's take a look. Never mind. Okay, you guys aren't following the news. Okay, you know what? Someday when you crack a joke, I'm not going to laugh at it. See how you feel. Okay, so what happens now? We take a look, and we have this Wiley Consulting, and they purchased $7,000 worth of supplies, paid cash immediately. What journal entry should I make? Hello, can we make this an easier question? You got to credit cash, don't you? Okay. Brown Consulting paid $5,000 for utilities. Are you kidding me? I mean, what is this, the remedial accounting exam? You have to credit cash, don't you? I think so. I think the whole test is remedial. I'm just kidding. It's about to be remedial. I think it's easy, though. Huh? Yeah, I mean, I don't have an objective opinion on that, or a unfiltered opinion. I don't know what you'd call it. Okay, on July 1st, Plum Company paid $7,500 cash for management services to be performed over a 2-year period. Plum follows a policy of recording all prepaid expenses to asset count at the time of the cash payment. Well, of course. I mean, what else would you do? What are you going to do? Just sit back and not make a journal entry when you pay cash? You got to make a journal entry, right? And since it's going to be a prepaid asset, you have to debit the asset, right? Okay. And so what should you do? Debit my what? Prepaid expense, credit the cash. An account linked with another account that has an opposite normal balance that is subtracted from the account is called a contra asset account. Oh, I erased it. It was over here. We had accumulated depreciation going against equipment, didn't we? Accumulated depreciation is a classic example of contra. Contra means opposite, doesn't it? 18. J. Brown Consulting paid $2,500 cash for a 5-month insurance policy which began on December 1st. Given the choices below, determine the general journal entry that Brown would make to record the transaction. Well, we know it's going to be either one of these credits to cash, isn't it? And what? Since it's at December 1st, none of that has expired yet. We're going to debit prepaid insurance. We're going to credit the cash, right? With me so far? Now, let me ask you something that's not asked here. Okay? We're going to sit there and we're going to say that if we have a $2,500 insurance policy and it has 5 months on it, what is going to be the expense per month? $500? Okay, so what journal entry do you want to make on 12/31? Journal entry? Debit what? Debit insurance expense for how much? 500? And credit the prepaid, right? For 500? So if I asked you what's the balance in the prepaid insurance account at 12/31, what would you say? It's going to be down to $2,000, isn't it? Right? Okay. Okay, good. The total amount of depreciation recorded against an asset over its entire time the asset has been owned is what? Accumulated depreciation, 120, 240, 360. Right? Just going off that example we just did. ABC Catering received $800 cash from a customer. What should we do? We're going to do what? To provide, to be $800 cash from a customer for catering services to be provided next month. Have we earned that revenue yet? We have not, so we debit cash, we credit what? Unearned revenue. 21, the company paid $100 cash dividend. What do? Debit dividend, credit cash, right? 22, Able Graphics received a $400 utility bill that is not due until the end of the month. What should we do? take our expense, set up the pay a bill, right? Don't we have a bill we have to pay? By the way, if this is like, where's all this coming from? Go back to the in-class example. Every single one of these now is going back to that very first in-class example, isn't it? Okay. Okay, good. Number 23. Number 23, HH Consulting and Design provided $800 of consulting work. Provided $800 of consulting work and $100 of design work. It billed the client for the total amount and is expecting to collect from the customer next month. So we're looking, and we have an account receivable of what? $900, and they credited the revenue in two different line items, but it's still all a credit to revenue, isn't it? Okay. On January 1st, a company purchased a 5-year insurance policy for $1,800 with coverage starting immediately. The purchase was recorded in the prepaid insurance account, and the company records adjustments only at year end. And after the adjusting entry, only at year end, the adjusting entry at the end of the first year, $1,800 insurance policy for how many years? 5 years. That's $360 per year, isn't it? So at the end of that first year, debit the insurance expense, credit, Item D, debit the insurance expense $360, credit prepaid insurance what? $360. I mean, who's choosing this answer? Yeah, but the debits have to equal the credits. Give me a break. Right? Okay. Okay, good. Unearned revenue is reported in the financial statements as what? Liability. 26. Which of the following of assets is not depreciated? Land. Okay. On May 1st, sellers marketing company received $1,500 from Franco Marchiselli for a marketing campaign effective from May 1st to April 30th of the following year. Cash received was recorded as unearned fees, and at the end of the year, December 31st, 1,000 of the fees were earned. I mean, this is a question that cloaks itself in hardness, and then all of a sudden comes up and just coughs up the answer to you, right? And says, okay, don't take my lunch money, please, okay? And it just gives you the answer. We would debit the unearned revenue and credit revenue for the 1,000 that was earned, right? It set itself up all tough, didn't it? Like it was going to make you do all these calculations, and then it just told you how much had been earned. Debit the unearned, credit the earned, right? 28. A company pays each of 2 office employees each Friday at a rate of $100 per day for a 5-day week beginning on Monday. If the monthly accounting period ends on Tuesday and the employees work both Monday and Tuesday, the month-end adjusting entry, 2 employees, how many days? Monday, Tuesday, 2 days, 100 each. That means those people earned $400 those first 2 days of the week. The last 2 days of the month are the same thing here, aren't they? Right? So if we got the last 2 days of the month, then we have to debit salary expense for 400, credit salaries payable for 400. That is not hard. Give me a break. Why is that hard? 2 days, 2 employees, you take the expense. I'm not supposed to show you that. That's like, the Wizard of Oz where he says, never mind that man behind the curtain. Okay, you're not supposed to see what... You guys saw the Wizard of Oz, right? Okay. Huh? You never saw the Wizard of Oz? Oh, you missed out. Okay. Okay. Anyway, so what happens? More accrual of payroll. Okay. So we've got what? Company pays employees $4,000 each Friday, which amounts to $800 per day for the first 5-day work week that begins on Monday. If the monthly accounting period ends on Thursday, then how much should we accrue? That means those people worked what? 4 days $800 a day, 3,200. Debit what? Good. Debit salary expense for the 3,200 and credit what? Credit the salaries payable for 3,200. If you have any problems with questions like this, pretend you're the one getting paid. And you'll immediately be able to figure it out. You'll say, well, wait a minute. I worked 4 days. It was $800 a day. You owe me $3,200. Make sure you pay me tomorrow, okay? But put down that you owe me $3,200 right now, because I don't want you to forget. Right? Okay. Okay. And you debit salary expense, credit payable when you're trying to accrue. Okay, so what do we got? We got about 15 minutes left.